Your name is on somebody else's bank account. Maybe it was added to help a grandson start out, or placed on a sister's savings account so someone could access emergency funds if she were hospitalized. You have never withdrawn a single dollar. It is not your money, and everyone in your family understands the arrangement. Yet as far as the Social Security Administration is concerned, every dollar in that account belongs entirely to you. That is not a mistake somebody made. It is the default policy written into the agency's operating manual, and it has existed for years. But the enforcement mechanism behind that rule just fundamentally changed. For a long time, that policy only triggered consequences if an investigator actively went looking, or if a red flag appeared. The agency asked what you had, you reported your balances, and if the reported amount stayed below a certain threshold, the inquiry ended there. That manual honor system is over. As of this year, the agency deploys an automated electronic verification network that scans financial institutions across the country on virtually every new claim, regardless of what is reported on paper. It does not wait for a red flag. There is no longer a dollar figure you can stay under to avoid it. And the search does not merely confirm the accounts you disclosed, it actively goes looking for the ones you did not. The machinery driving this shift is called Access to Financial Institutions, known internally as AFI. It is a direct digital pipeline connecting the federal government to commercial banks and credit unions, pulling real-time balance records without requiring prior written notice to the account holder. It is not new. It has existed for years. What changed is two things. First is the elimination of the reporting threshold. Previously, minor reported balances acted as a speed bump, bypassing full electronic searches. Beginning in August of last year for individuals aged 65 and older, and expanding in April of this year, the agency instituted a zero-tolerance policy. The digital search executes automatically, even if an applicant reports zero countable assets. Second is the operational reach. The electronic sweep is no longer reserved for a sample or suspicious cases. It now covers essentially all newly approved claims, reopened cases, and appeals that establish eligibility. The technical reach of this infrastructure is nationwide. The automated AFI system connects to roughly 96% of all financial institutions across all 50 states, the District of Columbia, and U.S. territories. For the small fraction of non-participating institutions, manual verification protocols remain in place. The automated network can run up to 10 distinct geographic searches based on an applicant's address and personal identifying data. If an applicant has a representative payee managing payments on their behalf, those searches can run against the representative's identifying records as well. The system is built to locate what federal rules classify as liquid resources: checking accounts, savings accounts, money market funds, certificates of deposit, credit union share accounts, and forgotten specialty accounts like Legacy Christmas Club or Holiday Club accounts opened decades ago at closed bank branches. To understand the stakes, the legal boundaries of this enforcement must be stated plainly. This automated asset scanning applies directly to Supplemental Security Income, or SSI, the federal needs-based safety net governed by strict statutory resource limits. If you receive standard Social Security retirement benefits based on your own work record or Social Security disability insurance, there are no resource limits on those programs, and this search is not reaching your accounts today. Yet the expansion carries massive implications. First, millions of families are directly connected to someone who relies on SSI, a parent, a disabled adult child, or an elderly relative. Second, this operational network establishes the exact digital infrastructure required for any future policy proposals seeking to means test other federal entitlement programs. The capability is no longer theoretical. It is being built and tested right now. Consider what happens to individuals in real-world scenarios. Take the case of Ola. Ola is 77 years old and receives Supplemental Security Income. She lives in a single room in her daughter's home, with all her belongings fitting into a single chest of drawers. 11 years ago, her brother faced a severe medical diagnosis. To ensure someone could manage his expenses if he became incapacitated, the family added Ola's name to his personal savings account. Her brother recovered. Yet, nobody ever removed Ola's name from the account. Today, that account holds approximately $9,000. Not $1 belongs to Ola. She has never possessed an ATM card for it, has never initiated a transaction, and does not even know the specific bank where the funds are held. The automated AFI verification sweep does not evaluate personal intent or family context. It detects an active financial account bearing her name and the agency's operating manual applies its baseline legal presumption. The entire $9,000 balance is treated as a liquid resource belonging completely to her. Ola is not attempting to conceal assets. She simply does not know that a favor done for her brother 11 years ago is logged as a disqualifying asset in a government computer. This is the first and most widespread asset trap, the joint account presumption. Under federal operating rules, if your name is attached to a bank account alongside another individual, the Social Security Administration's starting position is that 100% of the balance belongs to you. Not half, not an equitable share, but the entire balance. The underlying legal logic rests on the standard of availability. Because any joint account holder possesses the legal authority to walk into a branch and withdraw the entire balance at will, the agency treats those funds as fully available to you. And in needs-based programs, availability is the exact metric that dictates qualification. However, that classification is an evidentiary presumption, not an irreversible verdict. Federal guidelines permit individuals to formally rebut this presumption. If a claimant can document that they did not contribute capital to the account and do not utilize the funds for personal support, the agency possesses the administrative authority to remove that balance from the countable resource ledger. Furthermore, when an asset rebuttal succeeds, the exclusion applies retroactively, as well as prospectively, shielding past eligibility rather than merely adjusting future payments. Overcoming this presumption requires concrete documentary evidence. First, deposit records tracing the original source of all incoming funds directly to the other party. Second, comprehensive transaction histories demonstrating that the recipient has never executed a withdrawal or transfer. Third, a signed, formal written statement from the actual account owner detailing the exact administrative purpose of the arrangement and confirming sole ownership of the capital. And fourth, an updated signature card from the financial institution formally removing the recipient's name from the registry. Securing that removal at a local branch is the cleanest resolution. If maintaining a name on an account is unavoidable, establishing that documentary record immediately is critical. The person who can formally certify the arrangement is a living individual who may face future illness or cognitive decline. A signed declaration executed today settles the evidentiary burden permanently. A statement that cannot be signed tomorrow does not exist. A closely related pitfall involves representative payees and guardians. When managing funds for a disabled family member or grandchild, any account holding those funds that carries your name can trigger an automated match during an asset sweep. By law, these funds must be held in dedicated, formally designated beneficiary accounts. If fiduciary funds are commingled with personal checking or savings balances, establishing legal separation after an audit begins becomes exceedingly complex. The second hidden asset trap involves routine financial assistance provided by family members. When a relative deposits funds directly into a recipient's checking account, such as a child sending $200 each month to assist an aging parent, that transfer is classified as unearned income in the month it arrives. If any portion of that cash remains in the account after the month concludes, it converts automatically into a countable liquid resource. Over time, modest recurring family support can accumulate, quietly pushing an individual across the statutory asset ceiling. There is an established, fully compliant alternative. Under federal rules, third-party direct vendor payments are treated differently from cash transfers. If a family member pays an electric bill, a medical expense, or a utility charge directly to the service provider on the recipient's behalf, those funds do not enter the claimant's bank ledger and do not accumulate as countable bank resources. That single operational adjustment protects continuing eligibility without costing the family an additional cent. The third category consists of dormant and forgotten accounts. Decades of banking consolidation have created thousands of orphan accounts. A savings account opened at a regional bank that was subsequently acquired by a larger institution, with statements sent to an address abandoned years ago, remains active in core banking ledgers. A credit union membership account opened decades prior to secure an auto loan, still carrying a nominal $60 minimum balance, is an active account. Certificates of deposit established by extended family members in the past remain linked to an individual's Social Security number. The automated AFI sweep does not distinguish between active daily accounts and forgotten 30-year-old balances. It aggregates every match it finds. The fourth category involves pending lump sum payouts that individuals have already budgeted in their minds. An anticipated inheritance, an unresolved legal settlement, or a pending retroactive compensation payout does not count while held in probate or escrow. But the exact month after those funds are dispersed into a claimant's possession, they convert immediately into countable liquid assets. Recipients who plan financial commitments months in advance often fail to account for the speed with which administrative rules categorize those funds as disqualifying resources. The fifth and most decisive operational mechanism is the snapshot timing rule. Federal asset limits are not calculated as a rolling average, nor are they evaluated continuously throughout the billing cycle. The assessment occurs at a single, fixed point in time, the first moment of the first day of the calendar month. The balance sitting in countable accounts at the start of the first day of the month is the exact figure that governs eligibility for that entire monthly cycle. Consider the real-world mechanics. If an incoming payment arrives on the 28th of the month, and the recipient uses those funds over the following days to pay rent, settle utility obligations, purchase groceries, or acquire prescription medications, those funds are depleted. When the calendar strikes the first of the subsequent month, the capital is gone, and the countable balance remains under the limit. That is standard household budgeting under existing guidelines. However, if those exact same funds sit in the account into the first day of the month, they are recorded as countable resources. If that balance pushes total assets over the threshold, the entire monthly benefit is forfeited. Critically, attempting to avoid this snapshot by giving money away triggers severe statutory penalties. Federal regulations explicitly penalize the transfer of assets for less than fair market value in order to maintain program eligibility. Gifting funds to relatives or transferring title to third parties creates a mandatory period of program ineligibility far more damaging than the balance itself. Spending resources on legitimate personal living necessities is fully permitted. Transferring capital to hide it is an administrative violation. Understanding the enforcement landscape also requires understanding what the system is legally prohibited from touching. A comprehensive list of statutory exclusions protects primary assets from countable resource calculations. First, your primary residence. The home you occupy and the land it sits on are completely excluded, regardless of market valuation. A fully paid-off home does not disqualify a beneficiary. Second, one primary vehicle. One automobile is excluded regardless of its cash value, provided it is used for transportation by the recipient or a member of the household. Third, ordinary household goods and personal effects. Furniture, personal appliances, and wedding rings are not tallied against statutory ceilings. Fourth, burial plots. Dedicated plots designated for the recipient and immediate family members are fully exempt. Fifth, a designated burial fund up to $1,500. However, this exemption carries a strict operational condition. The funds must be held in an account explicitly designated for burial expenses and kept completely separate from general liquid capital. If that $1,500 sits inside a standard daily checking account, the agency counts it against the asset ceiling. Moving those funds into a segregated account is the difference between exceeding the statutory limit and remaining compliant. Sixth, federal tax refunds. Any federal income tax refund, including the earned income tax credit, is legally excluded from countable resources for 12 consecutive months from the date of disbursement. A refund deposited in the spring does not count toward the asset limit during that summer, fall, or winter. Seventh, retroactive benefit payments. Lump sum back payments issued by the Social Security Administration, or SSI, are protected for 9 full months following receipt, giving recipients time to deploy those funds toward critical needs. Eighth, ABLE accounts. Under the Achieving a Better Life Experience framework, individuals whose disability was established before age 26 can maintain up to $100,000 in a qualified ABLE account without breaching the standard $2,000 resource threshold. Misinterpreting these exclusions carries real financial consequences, as seen in the experience of Dorcas. Dorcas is 69 years old and receives SSI. When she received an $1,100 tax refund, she operated under the persistent fear that holding the cash would trigger a permanent cancellation of her benefits. For several years, she rushed to spend every dollar of her refund on unneeded items just to force her account balance below the limit before an audit occurred. Her refund was legally protected for 12 months. She drained her own savings simply because of incomplete information. Furthermore, crossing the asset line triggers a specific administrative sequence that few recipients understand: suspension versus termination. Exceeding the resource threshold does not permanently revoke a claim overnight. It places the case in temporary suspension, pausing disbursements for the specific months an account remains over the limit. Once resources drop back beneath the ceiling, payments resume. However, if an individual remains ineligible for 12 consecutive months, the file shifts from suspension to formal termination. Once terminated, eligibility cannot simply be reinstated. The individual must initiate a brand new application from scratch, enduring full administrative review. Simultaneously, beneficiaries residing with relatives must account for in-kind support and maintenance rules. If family members provide uncompensated food and shelter, federal calculations can reduce monthly benefit disbursements by up to roughly 1/3. Finally, the expansion of automated account scanning has triggered a surge in predatory financial schemes. Fraudulent callers posing as federal compliance officers or verification specialists increasingly contact seniors, claiming that their bank accounts must be pre-cleared or shielded from the new electronic system in exchange for a fee, a portion of their monthly check, or direct verification of their social security numbers and bank routing credentials. The operational reality is absolute. No third-party entity can shield an account from official verification, alter an audit sweep, or pre-clear balances for a fee. The Social Security Administration executes automated sweeps directly through participating financial networks and does not initiate unsolicited telephone demands for banking credentials. When an administrative verification or redetermination notice arrives from the agency, the greatest risk to eligibility is not disclosure, it is silence. Consider the experience of Isham. At 81 years old, Isham received a standard federal redetermination form. He understood nearly every requirement, but stalled on a single question regarding an account he could not clearly recall. Planning to consult a family member over the weekend, the notice was placed on a shelf, then moved to a drawer, and ultimately left unanswered. The account in question was a dormant credit union balance containing exactly $41. That $41 would not have impacted his benefit calculation by a fraction. But the administrative silence triggered a months-long compliance review, freezing his file and generating prolonged disruption over an amount that was never an eligibility violation. The underlying reality driving these widespread disruptions is not an epidemic of deliberate fraud. It is statutory obsolescence. The statutory resource ceiling for supplemental security income is $2,000 for an individual and $3,000 for a married couple. That number was set by Congress in 1989. It has not been updated since. Unlike standard Social Security benefits, cost of living adjustments, and tax brackets, the SSI resource ceiling is not indexed to inflation. Had that $2,000 threshold been tied to standard inflation metrics alongside the rest of the federal code, it would exceed $5,000 today. In real economic terms, the allowable financial cushion a beneficiary is permitted to retain has eroded by roughly 2/3, even as the maximum monthly payment remains under $1,000. Federal oversight reports reveal that investigators identified nearly 199,000 individuals who received a collective $718 million in disbursements tied to undisclosed accounts. Internal estimates project that systematic account scanning could prevent approximately $2 billion in improper payments annually. Because overpayments convert into official federal debts that are subsequently clawed back from future monthly survival checks, early detection prevents long-term compounding liabilities. Yet the structural contradiction is stark. The enforcement apparatus has been modernized into a real-time, automated, nationwide digital dragnet, while the underlying financial limit it enforces remains frozen 37 years in the past. The federal government has constructed an exceptionally sophisticated mechanism to police an asset boundary that has long ceased to reflect modern living costs. Navigating this reality comes down to 5 direct administrative measures. First, audit every single banking instrument carrying your name, including secondary checking accounts, certificates of deposit, credit union shares, and joint accounts established for relatives. Second, resolve all joint accounts. Either remove your name from signature cards at the branch level or compile the necessary evidentiary record deposit histories, withdrawal logs, and signed owner affidavits while the true account owner is alive and able to certify the arrangement. Third, isolate dedicated burial funds. Up to $1,500 is fully exempt, provided it is held in a segregated, designated account rather than mixed with daily checking funds. Fourth, monitor account balances precisely at the first moment of the first day of each calendar month, leveraging statutory protections for tax refunds 12 months and retroactive back payments 9 months. Fifth, Respond to every redetermination inquiry immediately upon receipt, retaining copies of all submitted records. The experiences of Ola, Dorcas, and Isham reflect millions of American households navigating an entitlement system where automated enforcement has accelerated, while statutory rules remain trapped in 1989. Understanding how that digital net operates is the only way to ensure basic family assistance is not quietly swept away by automated math.